All right, in today's video, we are going to look at the same attorney that we looked at in the last video and the whole life insurance policy he is interested in. What we are going to focus on specifically in today's video is his question around a guardian policy and their direct recognition treatment. So in our last video, we went over funding flexibility with Mass Mutual and Guardian. Specifically, we looked at catch-up payments, which was really interesting to see. So as we look at the next topic, which is direct recognition, here's where he was at. He stated this about the flexibility. He said, I like Guardian, especially when it comes to getting money in, because my target here is to be able to pay $300,000 per year for 10 years. That gets a total of $3 million in. With Guardian, I can commit to $30K per year, approximately. Comes out to about 31 with the term rider, but I can commit to $30K per year, and then 100% at discretion, I can just throw more money in, meaning it never feels like a burden to me based on my income and cash flow today. So financially, I will not be stressed out and I can add more funds at leisure. So from a funding standpoint, this is his preference. So check mark for Guardian there. Where he had questions and really wanted to understand the product was here, direct recognition. How does direct recognition work? When you borrow against a life insurance policy, the outstanding funds, meaning the dollars you have borrowed, receive a different dividend rate than the non-borrowed funds. Depending on the company, the dividend rate applied to the borrowed funds may be higher or lower than the standard dividend rate. It also depends when you started the product. We're going to focus on new Guardian products in this particular case because he's interested in a new Guardian product. If you have an existing Guardian policy, I would check out one of our older videos, or you can ask us if you have questions on how the loans work. So, without getting into all of the details, because we've got other videos that go through the direct recognition treatment, here's what he's interested in, and we're going to focus on the bottom line. What's the impact that loans have on his policy? That's what he wants to know. So what he requested specifically is this. Show me the option, Steve, where I fund $300K per year for 10 years. Let's look at that option. But what I want to see with that particular funding scenario is if I take a loan in policy year 2 of $250,000, I pay the interest every year and then repay the principal over 5 years, which comes out to $50,000 per year. What impact does the direct recognition treatment have on my policy? Let's look at exactly that. So let's look at our illustration here, which is a lot of fun. I say that sarcastically. It looks like stereo instructions here. So we've got the policy design. We looked at this in the last video. This is just the basic dividend illustration. You can see the indexed rider at 0%. But when you have funding and loans coming out, there's a lot going on. So just very quickly, because we went over this with him, net premium, this represents the premium, term rider premium, and PUA premium payments. So everything that I'm paying into the policy, premium dollars, rider dollars, the PUA rider, and then also term rider dollars. Annual loan, the loan I'm taking, $250,000. That's money I'm taking. Now, this negative $50,000 represents money that I'm paying back to my policy or paying back to the insurance company through a loan repayment. So I'm applying $50,000 per year toward the loan principal. Cumulative loan represents the total loan balance. Here we've got loan interest, and we are paying it in this example. So this is money out of our pocket or out of his pocket. The net after-tax outlay, this is the one that can be confusing. This takes into account any premium dollars you pay in, loan dollars you take out, and then interest you pay. Oh, and I almost forgot loan principal payments too. So it lumps everything together and says the net payment this year was $300,000. In year 2, you paid in $300,000, you took out $250,000, then you paid $11,905 in interest. Therefore, your net payment was $61,905. There's a lot going on here without getting into more details. So the illustrations are important because they provide full disclosure. So anytime we're working with someone, we're going to send this, the full illustration with this info, and we will absolutely walk through the illustration with you if you'd like. But what helps, in my opinion, is laying it out on Excel side by side. So what we have here is as follows. On the left, the growth illustration. On the right, loan and repay, and we're going to look at exactly what he requested. So what do we see in the growth illustration? Year 4, break even. By year 10, the cash value, 3.49. And let's look at year 7 as well. You'll see why. 2.276. Okay. The loan and repayment scenario. He wanted to take a loan in year 2, $250,000. The amount that determines how much you can loan is whatever you have in cash value. I like to think of that as the available equity. When I borrow, interest will be due. Also, I'll see my death benefit collateralized dollar for dollar. So notice the growth illustration, death benefit is $10 million. When I take that $250,000 loan, the death benefit is $9.75 million. If you die with a loan outstanding, that death benefit is reflecting the net amount that would be paid to his beneficiaries. So the next year, what do we see? Funds $300,000, so he's still funding while he's actively using the policy. Then in purple, we're looking at money out of his pocket. There's the $11,905. He makes an interest payment and then applies $50,000 toward the loan principal. The loan interest rate, by the way, is 5% fixed, but it's 4.76% if you pay it on your anniversary date, meaning if a loan's outstanding, Guardian will send a bill for the loan interest, and if you pay it, that's the effective rate you will notice. So what he does here is pays it back over 5 years. All right. Year 7, death benefits restored. What's your cash value? $2,266,000. What was the example where we let it sit and grow? $2,276,000. So at this point in time, he's paid in $2.1 million, and the difference, just about $10K. $10K less. Why it's less is because the dividend applied to loan dollars is less than the dividend applied to non-loaned dollars. Non-loaned dollars receive the standard dividend rate of 5.75%. When I say standard, I'm referring to the 2023 dividend rate. And then loan dollars, the effective dividend rate comes out to about 4.5%. Again, that's new Guardian products. And that can change. Just like dividends are not guaranteed, the treatment with loans and how dividends are applied to loan dollars is not guaranteed either. But that's what he requested. And from a business perspective, I'm a firm believer in showing individuals what they want to see. With that said, this is a small loan relative to the dollar amount he's paying into the policy. And it makes it look like when you borrow, there's a minimal effect. And there is when I look at the numbers in this situation. Like I look at it by year 20, and 5.3 in the non-borrowed scenario, 5.28 million, a $20,000 difference with almost $6 million or $5.3 million in cash value. It's like, all right, that's not that much. But what happens if you look at a much larger loan or amplify the situation? That's something where I look at this and say, okay, I think it's important to show because I do not want him to feel like he ran into a gotcha situation. I wouldn't want to feel like that. And that just comes from asking the right questions or having someone ask the right questions for you. So going back to the whiteboard there, we looked at exactly what he wanted to see, but then what I also threw in here was this. If I'm you, what I'd also request here is seeing a larger loan. Maybe let's look at one much higher than you'll ever take, a $2 million loan. This way, you can really see the impact of the direct recognition treatment, because when we spoke, he asked about that multiple times. He had a lot of questions. And this makes it look like, it's no big deal at all. And if that's all he does, or if he's taking loans and paying them back very, very quickly, the direct recognition is not going to impact the policy very much. But what if he takes a larger loan and pays it back over a period of time? Then you'll see an impact. So what we put together here, we've got the same illustrations on this, but we'll just look at the Excel, is this. On the left, you've got the exact same growth illustration, because it's the exact same policy. Then we've got the exact same loan scenario over here, the 250, and paying it back at 50 per year. Look what happens to your death benefit too, as that loan balance is paid down. But then in year 8, once the first loan was paid off, illustrated another loan coming out. And you can take multiple loans even when you have a balance outstanding. You've got all the flexibility in the world. But here, took a $2 million loan out, which is the majority of what he had in cash value. So there's the death benefit collateralized. Here's the loan interest. What do you notice about the loan interest? The same for 3 years. What I ran here is a scenario that many people are attracted to or practice themselves, which is paying the interest only, especially if it's a large loan interest bill, while they are aggressively funding the policy. They only want to fund it for a few more years. And then, after the 10th year, if you recall our last video, he doesn't want to fund it longer than 10 years, begin to take the cash flow you were directing toward the policy and pay down the loan. So attacking the principal with that. Now what happens? 4.676 in the non-loan scenario, 4.47. Now there's a difference that's noticeable, isn't there? Cash value difference over here, just over a $200,000 difference. So that's loan scenario number 2, demonstrating direct recognition. Here's what I'll add. When we look at that often makes one feel like, I don't want direct recognition because I see my value less than what it would have been if I never touched it in the first place. That part is true, but here's the other thing that really has to be considered, in my opinion. How much are you paying in loan interest? Because it's a direct recognition policy, but direct recognition policies, in many cases, will have a fixed loan interest rate associated with them. So what does that mean? Well, if interest rates are higher than 4.76%, with a policy with a variable loan rate or with cash value collateral loans, you're going to pay less interest to Guardian in this case. So you are saving in loan interest in this particular case when we compare it. If loan interest rates are lower elsewhere or right around 4.76%, then I could use the cash value collateral loan with a bank or lender to save on interest there. But especially when you look at large loans, this has to be considered. So the interest I paid was $592,000. If I go and look at a cash value collateral loan, right now, I might see rates around 6.5%, could be a little bit higher. Depends on what bank I'm using and such, and rates have changed a lot recently. But 6.5%, what happens if I plug this same loan payment or this loan scenario into a cash value collateral loan calculator? Let's take a look here. Remember the total interest you paid, $592,000. So if I pay $792,000 in loan interest with a non-direct recognition policy or a cash value collateral loan, doesn't make much of a difference, does it? $250K loan, paid at $50,000 per year for 5 years. There we go. Interest rate, 6.5%. We've got the same growth illustration on the left. Okay. Then, year 8, we took the $2 million loan. 1, 2 little zeros. and then paid that beginning year 11 at $300,000. Now think about this, that variable rate will change as time passes. There we go. So at 6.5%, how much did you pay? $809,000, which is how much more? It's more than $200,000. It's close to the difference there, believe it or not. Insurance companies have this figured out, by the way, with non-direct and direct recognition. In fact, I'll say this, especially when speaking about the major mutual companies, because you'll see direct and non-direct recognition practiced with both of them. It doesn't make much of a difference. We've heard opinions as far as one being better than the other, or always go with the non-direct recognition, or it doesn't matter if I look at direct or non-direct recognition. My stance is this: if we're with one of the major mutual companies, the policy is designed properly for maximum cash value, regardless if it's direct or non-direct recognition, I don't think it makes much of a difference. Just because when we look at the numbers, not just based on illustrations, but actual policies, we haven't seen any evidence of one type of strategy or product screaming at us saying this is better. As time passes, if one does scream at us that this one's better, we will definitely let you know. But when you look at a non-direct recognition policy, usually you have a variable loan interest rate. So how the insurance company protects themselves is if it's non-direct recognition, they're going to pay the same dividend to you, regardless if you have loans outstanding or not. But if dividends go up, that means that loan interest rates are probably higher as well. So when you borrow, you're going to pay more in loan interest. Whereas if you have direct recognition and a fixed loan interest rate, there's some companies that go variable with direct, but most are fixed. You've got a fixed loan interest rate. If it's low, it's locked in at that low rate. So you're going to pay a lesser loan interest cost. If the dividend goes up, a higher dividend is applied to non-borrowed funds. But often, in a case like this, we may see a lower dividend applied to borrowed funds. But with all of that said, I'm saving on loan interest with a lower loan interest rate. That's my long-winded explanation to say we haven't seen much of a difference there. What's more important is to make sure the product is designed right, and from a funding flexibility standpoint, it accommodates what you're looking for. Because frustration usually doesn't come from the loan treatment. It usually comes from the policy not being designed for maximum cash value or having a high premium where I would have preferred to have a lower one so it didn't feel like a burden. No, I talked a lot there and I talked kind of fast. Let us know if you have any questions at all. Let us know if you have any questions or thoughts on direct and non-direct recognition, if you like his loan strategy. And as always, I hope this helps. Thanks so much for watching. Hey guys, Steve here with IBC Global. Thank you so much for watching the video. If you're interested in a whole life insurance policy and you'd like to work with our company in setting it up, please visit our website, ibcglobalinc.com. We would love to work with you. If you have any questions, please leave them in the comments below. And as always, I hope this helps.